Markets are moving fast at the moment. Record highs for major benchmarks one day, then the biggest one-day declines in almost a year. The volatility or VIX index at lows not seen in 10 years, followed by the biggest one-day rise in volatility in a year. Lots of trading opportunities. Bryan Noble joins us now from TraderNoble.com. Bryan, welcome.
Jeremy, thank you for having me.
This is all bread and butter for you, isn't it? It's good times.
Yeah, it's been fantastic. As I've been saying for the last 6-7 months, once Trump got in, volatility was guaranteed to return, even though we had a very quiet few weeks with the VIX, hitting below 10 for only the 12th and 13th time last week in the last 28 years, and everyone just got complacent, and then bang, Trump gets rid of the FBI director, and the S&P then falls, biggest fall since last November.
Yeah, well, let's take a look at the S&P 500. In fact, you trade the June contract, don't you?
Yes, I do.
Which we've got up here. This is going back to 2015. But let's focus in on what's been happening recently. Explain what's going on.
Okay, well, interesting. The S&P made a new high on the 1st of March, as we know, at 24.01. Subsequently made a new high again this week at 24.06. Against that, the Dow didn't make a new high, and that's what I call intra-market bearish divergence. So the Dow March 1 high was 21,169. It couldn't get much above 21,000 the other day when the S&P broke up to 24.06. So that was the first warning sign. And then when Trump got rid of Comey, the S&P then fell quite substantially, as we saw. But interesting, if we go back to the round one of the French election, from the Friday, the S&P closed at 23.45 in Chicago, opened them on Sunday night at 23.70, traded to a low of 66 in the Chicago afternoon session. So that's what I call an open gap. So we had a huge gap from 45 to 66, which took almost 4 weeks to fill. But all open gaps in the S&P always get filled, whether they take a week, a month, 6 months or a year. So this gap was so big that it was attracting all the buyers. And normally when you get, I know we can all look at the left-hand side of charts and say we're all geniuses, but normally when you get these gaps to be filled, the first attempt will generally see a big rally, and that's what happened yesterday morning when the S&P traded down to a 44.5 low, just breaking the old 45 close from 3.5 weeks ago, and then bang up to 23.75 before we sold off late last night.
Okay, so when you get a closure of that gap, as we've had in the last couple of days or so, is that a good sign, a positive sign, a sign to go long, or are you now asking questions about the vulnerabilities?
Well, yes, certainly the vulnerabilities. These gap plays, the first time you always get, it's like an elastic band. The first rally is always quite significant. The second one, the next test, we might get half the rally, and the third or fourth test we generally tend to go through it. Against that, we have from Wednesday night's close at 23.97 in the S&P to the afternoon high, rebound high in Chicago, 23.84. So we have another 13 handle gap, which is quite big. Now, whether that gets filled in the next leg up before we sell off again, or it waits for another couple of months, that's the market will determine that. Key resistance today is 23.79. I think if we close the week above 23.79, I'd be more comfortable stating that we'll probably close this gap. Against that, if we break and close below 23.49 tonight, then that'll be weekly. That's a very bad weekly close, and then I think we'll start going down towards the 100-day moving average at 23.35, ahead of the real support, which is 2300 to 2310.
Yeah. Okay. All right. So looking for indications in the next few days. You're looking for? Is that likely to happen in the next few days?
Well, we just got to see where we close tonight. That's the first thing. So if we break 79, then we're back in the bull frame again. If we break 49, then we're in the bear frame. So at the moment we're trading 23.69. So we're kind of in the middle of this range. But with volatility moving 46%, I mean, I've never seen volatility move that high in one day in many years. So and the S&P, which normally trades 1 million contracts, did 2.7 million on Wednesday. So it's great to see a bit of volatility back for everybody.
Yeah, okay. Where else are we going with this? Because I think you're going to talk about the currency markets.
Yes, perfect.
Euro dollar?
Euro dollar.
Tell me exactly what's going on with euro dollar, because we've seen a recovery for the euro against the US dollar. In fact, I think we've seen levels now not seen since the 2nd of November.
No, and I've been on your show many times over the last months, and I've been very bullish of the euro. I thought the euro would head to 109, 110. Now we've hit just shy of 112. This 112 area is key. We're grossly overbought at the moment, way outside the daily Bollinger Band, the top of the Williams Index. If we close over 112 for 3 or 4 weeks, I think then the euro can run to 120 and possibly even 130. So this 112 area is key. I'm actually going short here against this huge resistance because of the overbought nature of the euro. We have a massive gap in the euro going back to that round one of the French election from 106.30 to almost 109. So at some stage this gap will probably get tested. So I'm hoping we'll get a bit of a sell-off first before we rally. A bit like the stock market. I think ultimately towards the end of the year we're going to see the real sell-off in the S&P. I don't think it's going to happen yet. I think we'll still probably make new highs over the coming months, and then we run into a bit of trouble later on. It's an incredible US economy. We've got full employment. We've no average earnings are very weak, so we've no wage inflation. I've never seen full employment without wage inflation. So if we didn't have full employment, like the US economy to me is slowing down, but we're not seeing it in the numbers as yet because this consumer I think is dead.
With the capitulation potentially of the S&P 500, is that when we're starting to talk about parity for euro dollar?
Well, I don't know if we get to parity. I certainly think this 112 is so key. I think we can certainly go back and close that gap and see what we can do from there. Yeah. Ultimately, I still think the dollar weakens as time goes on. I just think the US economy is, we've already seen with 3 rate hikes over the last 18 months that money supply has started to contract in a big way. So if we get another rate hike in June, again, we would have said ahead of Wednesday that was guaranteed. After Wednesday, we don't know if the stock market sells off over the next couple of weeks. I think that the Fed will hold fire.
Yeah, dollar basket, this is the dollar index. Explain what's going on here, because clearly there's a downward trend for the dollar, and indeed, like we've seen the euro break highs, we've got the dollar breaking new lows since, 7th of November?
Yeah, incredible. When I was here in January, 3 trading days left in January, I said that the dollar had to fall 150 basis points to have a key month reversal. Mm-hmm. Incredibly, the dollar did fall 150 points in those next 3 days. So the dollars fell 5% in January off the 103.80 high. 5% move, key month reversal, which are extremely rare. Nobody really talked about key month reversals, which I found very strange. 1st, 2nd February, the dollar continued to sell off and then had a huge rally in February to correct the oversold condition from the January sell-off. Did nothing really, just sort of traded in a range, and then earlier this week we broke 98.50, which is a key level for the dollar, and we've quickly gone down to test 97.20 where we are today. I think the dollar to get back on a firm footing, it needs to break back above 98.50. It's extremely oversold. The daily sentiment index is at the lowest level since August. The last time we were down at single-digit DSI readings, the dollar had a massive rally. So we're at key junctions for both the dollar index and the euro, which you'd expect when the euro makes up 57% of the dollar basket.
So your keen direction from here is where?
I'd be a buyer here against probably 96.80 to 97.10 as good support. So literally just below here, similar to the euro. I'm a seller between 111.70 and 112.10 with a tight stop. I don't want to let this run ahead. But the problem is when we're coming into weekends now, people are getting nervous because we don't know what the political situation in the States is going to be. So having positions after 8:30 on a Friday night can be dodgy, and that's why we're getting such. We get a lot of flurry of trading in the last half hour on the Fridays.
When you get markets sensing nervousness, you get a lot of money going into some of these precious metals. I mean, we've spoken about silver before now. Have you changed your view on silver?
Yeah, I'm not as bullish as I was. I've been very bullish at silver. Silver had a great run for me from the end of December, the 15.80 to 16, just at the bottom of your chart there. Huge support. We rallied all the way up to 18.60. We've double topped up there, had a key breakdown back below 17.50, and we've traded back down to a low yesterday of 16.42. Silver, it's kind of, for me, it's lost my love for it at these levels. I still think ultimately silver is fine, but we still haven't seen the infrastructure, the 1 trillion that Trump has promised to implement, still hasn't happened yet. And if that happens, then I think silver is off to the races again. But if you look at gold has been very, hasn't really, should have rallied more yesterday on the equity sell-off and didn't. It just ran ran into a brick wall there up at 1265, and there's a 4.5-year mega trend line for gold at 1280 to 1285. I think if gold breaks back above 1285, 1290 and closes over there for a week or two, then I think the bull market for gold is back. So all these markets are at critical junctures at the moment, and we'd have to see what the price action, how we go forward from here.
Yeah, I just want to bring up silver again, because you said we could possibly go to the races if a certain situation happens. You're talking about these levels here at about the 1865, I think that was a recent high that we had in April, or you're talking about beating that and going to the highs that we've seen, a couple of years, or no, it was August
July,
last year.
Well, 2104 was the high in July. We had a huge set-off, went from 2104 down to 1580 in December. Anyone who was bullish silver just got absolutely annihilated. If we break this and close over this 1865, then that's going to become, which is resistance at the moment, that'll become very good support, and then we should run up to those July highs at $21. So we know the levels to get back long. I just think at the moment we're kind of in no man's land. If silver can get back down below 1610, 1620 area, I'd be a buyer with a tight 1570 stop, which is just below the December low.
Great. Okay. All right. Bryan, looks a pleasure. Thanks indeed for joining us for today's look at the markets. That's Bryan Noble from TraderNoble.com with his view on that June contract for the S&P 500, euro dollar basket, and also silver.